Important terms and professions. There is a language specific to each market. To be successful at Forex trading, you need to know these words. Currency pair. There is always a currency pair involved in a Forex trade. Aside from the majors, there are also less common trades like exotics, which are currencies from developing countries. PIP. A PIP is the smallest possible price change within a currency pair, measured in points. There are 4 decimal places in Forex prices, so a PIP equals 1/10,000th. Bid-ask spread. Exchange rates are determined by buyers' maximum willingness to pay the bid and sellers' minimum demand they ask. A bid-ask spread is the difference between these two amounts and the final value of the trade. Lot. Currency buys and sells are measured by lots or standardized currency units. There are also micro 1000 and mini 10,000 lots available for trading, although the typical lot size is 100,000 units of currency. Leverage. Some traders may not be willing to put up such a large amount of money to execute a trade due to those large lot sizes. Trading on the Forex market without the needed amount of money is possible through leverage, another term for borrowing money, margin. Leveraging your trading can be expensive. It is also necessary for traders to put down some money upfront as a margin deposit. Lesson synopsis. A currency pair is the combination of two national currencies for trading on the foreign exchange FX market. The Forex market is more volatile during times of trade wars, elections, corruption scandals, and policy changes. A market's return will be maximized while risk will be minimized by investors. A PIP is the smallest possible price change within a currency pair, measured in points. Currency buys and sells are measured by lots or standardized currency units.